welcome to this week's series of Credent Connect. And today we're going to walk through the April 2026 recap. Quite an interesting turn of events across capital markets. Maybe not so much on the geopolitical front. There hasn't been too many advancements there. But it's important for us to walk you through the capital markets piece on particularly the equity side, the stock market side of things, because how things have materialized has been really quite interesting. I'm joined again by Alisha Norris, Senior PM here at Credent Wealth. And Alisha, it has not been a dull April, I can tell you that much, at least from our perspective. One of the things we were just talking before we started our recording here is just really focusing, and I'm going to share my screen here, on just that performance profile year to date. And many of you have seen a similar chart like this, so I'm just going to do a very quick 10-second overview of what we're looking at. This is what's called a normalized chart of performance, meaning we're starting with a base of $0, and how many dollars would we have on a percentage change basis and absolute basis if we invest that at the beginning of the year or at the beginning of a particular time period? The way to read this is, this white line, for example, is the S&P 500 right here. It says it's 105.6853. That means it's 5% gain for the year. This yellow line is our mid-cap index, and it's showing 110.55. That means it's 10% gain. We like to look at normalized charts as a function of how things have performed, and we're stripping out all the noise around us, looking at pure percentage changes. With that in mind, right, without getting too technical here, Alisha, walk us a little bit here. This is the year-to-date snapshot through April 30th of 2026 of how performance has transpired post that little blip in the early part of April, knowing full well we're in that critical midterm year here in 2026.
Yeah, so the last time that we gave an update about the markets in March, we had a completely different story. We were seeing that transition from a very strong year last year in the international markets to being more domestically focused as geopolitical tensions picked up. I think one of the things to mention, and that is extremely important in what we're looking at in this data, is looking at the strength in the mid and small cap space, as well as that big dip in the red line, which is the technology sector. And so what we saw is towards the end of March, a huge detractor from the S&P 500 in general, really led by those technology names. What we're seeing now is kind of a complete flip of the head, right, on that. And so if you look at the bottom near March 30th of that red line, what you're seeing is it's a pretty good resurgence in technology throughout the month of April. One of the things that we like to talk about is how Credent can play defense, right? We're really good at defense. If you look at that technology sector, if you were overweight in that sector, losing 50% means you need to gain 100% on the way up. And so one of the things that we do at Credent is really just staying diversified broadly and really playing defense.
Yeah, love that. I want to stress again what Alisha just said. If you lose 50%, you got to make 100% to the upside. And downside protection, right? Losing less, being protected better to the downside means you have to be less aggressive on the upside or take advantage of those aggressive names. We kind of did a little bit of that. I'm gonna zoom in here, Alisha, on just the April of 2026 performance. And that red line that Alisha was talking about, that is the S&P Information Technology Subindex, just looking at only the tech names. Predominantly in this case, right, for the purposes of this conversation, think of your big NVIDIAs of the world, your Microsofts, maybe some of your Metas, up 17% in just April. Yet we just saw in the previous chart version of this that it is one of the lower performance for the year. Think of it mathematically, right? Yes, it's up 17%. It was down substantially, over 12, 13% in the first part of the first quarter of 2026. Meaning it's easy to argue and make the narrative that these names will continue to increase in perpetuity. The volatility profile that comes with that, though, right? That volatility, that up and down, just mixture of these AI names is far beyond what most investors are willing to accept. Therefore, playing better defense, being better allocated and diversified is really important. Okay. How we look at that on a forward-looking basis, right? And Alicia, I'm going to pivot here next. I'm going to go to that third chart that we talked about because it's very much ties into this AI space and this technology space. When we look at that space, right, one of the questions we often get is, should we be over allocated to it again? Should we jump in with both feet? Should we be taking advantage of every single dip that occurs and actually buying more and reallocating? And the answer to some degree is yes. However, we're also very diligent in that risk management piece. And one of the things that we're paying very close attention to is, how is the market perceiving this allocation of AI? How is the market in general thinking about this potential for an exuberance in these individual names? So we're not left catching a falling knife. Okay. And what this chart here specifically shows is by the way, this is one of our maybe sneak peeks into everybody, how we use AI to a certain degree across the ecosystem. But here we're tracking every time the word bubble, as in a bubble in the market that could pop. Think of what happened during the global financial crisis, or even before that, during the great technology bubble, right? This tracks the mention of the word bubble in headlines across the entire ecosystem of major public articles that are available. We're showing this because the AI trend does remain relevant, but we have to remain balanced, right? And Alisha, walk us a little bit on, when we say balanced, how are we allocated today in that AI trade from the subset of what AI is, right? That AI has become synonymous with everything nowadays, right? I feel like my kids use AI now, and when we invest in AI. So, what do we invest in AI from that structure? How are we managing that?
So we get this question a lot from clients is, how am I invested within the AI names? And of course, we are remaining invested within the AI names, but we're doing so on a really balanced allocation. So we want exposure to things like developers. We want exposure to things like software and hardware, and to really remain relevant across the spectrum of what artificial intelligence across that entire space in those companies. So we're really doing it on a very diligent basis, and we're doing it in a way of equal weighting. We talk about that a lot, the way that the market cap indices can really skew towards a handful of names. We want to still be participating in those names, but we want to do it in a broad way, in a very diversified way. And so that's the approach we're taking when we allocate to artificial intelligence stocks.
Yeah, absolutely. And don't get me wrong, we have strategies that are absolutely concentrated on that. Certainly, if anyone is interested in just that subset, it absolutely exists. You won't see us recommending it as the best long-term solution, that's for sure. One quick thing to note here, you'll see that massive spike there of the bubble mentions in headlines near that mid-cycle of the year 2020, right? So other than COVID, the little thing called COVID that happened during 2020 at its peak, there was another phenomenon in capital markets that happened. And for those of you that recall the meme trading, the meme stocks, Alicia, what was that main meme stock that we refer to, that we talk about?
GameStop.
GameStop, right? Who remembers GameStop? That surgence of something like a 10,000% return profile. That was certainly a bubble. It did burst. This chart kind of shows it's funny now in retrospect to see that kind of a bubble structure, but very important to pay attention to it as a function of what's happening in the economy and what's happening to sentiment. With that in mind, right? So this is all great. This is fun. This is sentiment based. It's objective based. As it relates to the economy, though, one of the things that we really want to touch on is, how is the economy shaping out amidst the geopolitical tensions that are happening, right? Because it's easy to make an argument and pick one side of the trade during this geopolitical tension. That is also a great narrative for attempting to catch a falling knife. Do not recommend that. But what we do look at is, how are things actually transpiring relative to what is expected? And that expectation, right, from our standpoint is, what do the talking heads via the economists think is happening? Right? Each market data point, as an example, has somebody expecting X. And if something other than X happens, either causes this chart to go up or down. Before we talk about what's happening, Alicia, maybe give us a very quick, kind of very easy math understanding of, if we're above that zero, what does that mean? If we're below the zero, what does that mean in the aggregate scheme of kind of this chart?
So if we have a reading above zero, which we do today, it's 0.311. That means that actual market data is coming in better than what economists had expected. So we are positive and trending positive.
Yeah. So in other words, if an economist expects X, but Y happens, this chart says be on the positive side. What happens over time, as we're seeing here, actually since about the fourth quarter of last year in 2025, we've been trending higher. This is actually a classic sign of assessing and looking at it and saying economists aren't exactly sure what's going to happen to the economy. If there's this consistent beat of actual data points to the upside, above and beyond what expectations are, that tends to lead us in the direction of saying economists are kind of unaware of what's happening. And often that tends to be a really good time to be invested in the markets, right? Because you've heard us say this often. Markets rarely react the way the masses expect them to. I feel we should get a poster of that somewhere, Alisha, and just kind of put that up, right? Because the reality is, if markets in the economy react in the exact same way that we all expected it to, there'd be no need for a tradable market. We'd all be in the same boat, right? So with that in mind, the reason we're bringing this up here predominantly is the geopolitical landscape right now is easy, as I said, to make an argument for one way or the other. We do not time the market. We do not time the macro environment, but we are very well allocated and keep a very well structured approach. We'll continue to do that, and you'll hear more updates from us rather, on a continued basis.